Welcome back to the Early Stage Investor, where we're staying on top of an emerging early stage supply crunch in fossil fuels happening all around the world. This is the backdrop. The harsh truth, we're using more oil than ever. The planet is getting hotter by the day, but we can't shake our thirst for crude, right? And so because of this, right, we know countries are moving away from crude oil. They're trying to get away from it. They think fossil fuels are a thing of the past. And so we have a huge demand for it. Prices are rising for it. The companies that are producing it are cash cows. They are some of the wealthiest, producing the highest dividends, the best returns for shareholders now, because supply is tight, but demand is also extremely strong. These next charts come from Eric Nuttall from 9 Point. Sub indices, relative valuation metrics. So at the bottom, we see free cash flow yield. And to the left, we see consensus enterprise value to EBITDA, to earnings. What are these different assets across different industries being valued at? The further you are to the right bottom corner, the more undervalued you are, right? And the more cash flow you're kicking off. So what you can see is energy right now, energy companies at $90 WTI have free cash flow of 18%, way more than every other industry right now. Even energy companies at 70, still more than other industries. But then you can also see the EV to EBITDA, meaning they are the most undervalued by the market. So this is like a ball being underwater. Eventually, in this inflationary environment, people are going to want the dividend yields, which are way higher than inflationary bonds. And so very exciting if you have exposure to this space, because there's passive income to be made while you're waiting for the explosive upside when the market realizes what we're talking about right now. U.S. road transportation demand in purple, 2023, no lower than at any other year of the last four, right? So demand is still strong, while global observable oil inventories are at their lowest on record, okay? So we have strong demand and we have very tight supply, a beautiful setup for these already cash cow companies to make even more money in this environment. So that's the setup for oil, staying on top of that market. But here is the setup for coal. This comes from Whitehaven Coal, a mining company over in Australia. This is the supply gap forecasted for high CV coal, high quality coal, which is what Whitehaven and a few other companies produce. 2023, we're not in a supply crunch quite yet, but look at the projection, right? Clearly, demand, which is the line at the top of the chart, isn't going anywhere. We talked last video how China and India are growing their demand for coal, but look at the multi-decade supply crunch ahead for these cash cow coal miners, right? They're just going to continue making more and more money in the depths of this because no one is going to be investing in coal, even though demand is hardly shrinking. In fact, it's growing. These are the projections, again, from Whitehaven showing demand projections. And so there's four different organizations that this company got demand projections from. The light blue is showing demand falling massively in 2040, and that's based on optimistic assumptions around achieving net zero. Now, we know most countries in the world are completely bankrupt, including the United States. Where are they going to get the trillions, if not 20 plus, 30 plus trillion dollars required to make net zero a possibility when they're bankrupt already? It's going to be a tough order, right? So cheap energy will continue to be valued around the world. So there's that light blue projection, probably optimistic for the net zero enthusiasts. And then in black, and then so you can just see the average is steady all the way into 2040. Again, tight supply, strong demand is a beautiful setup for commodities. And so we're just going to have to stay on top of this market. Reach out if you have any questions.